Hello, Reality and XT viewers. Get ready for an exciting new episode of Let's Talk Business series. Join us as we welcome the esteemed Mr. Amit Goenka, founder and managing director of Nisus Finance Group. Discover Nisus Finance's dynamic presence in the real estate sector and its leading role as an alternative asset advisor and manager in the Indian market. Mr. Goenka's visionary leadership has driven Nisus Finance to new heights, and we will explore their core focus, investment strategies, the upcoming trends in Indian real estate market. So don't miss our insightful discussion on the impact of the technology, their success in resolving stuck assets, and much more. So stay tuned to gain valuable insights into the exciting development in the real estate market and the future prospects for Nisus Finance. Thank you, Amit, for joining us today on Let's Talk Business by Reality NX.
Thank you so much, Kritika. It's a real pleasure to be with you on Reality Next. I'm amazed by the cutting edge information and research that you're doing at Reality Next, and very happy to be part of your endeavor.
Thank you so much. So, Amit, before we delve into the business of finance and investment, let's talk about you. I want to know what inspired you to enter in this particular industry and make our viewers go through your journey, the time you entered till now you have become the founder and the CEO, managing director of Nisus Finance.
Sure. Thank you, Kritika. Something that I generally don't talk about, but happy to share. In the last 25 years, I've seen a large ecosystem within India, within financial services and investments. It started with the traditional way of investing, which was either through equities or through mutual funds and very select private equity. My own journey, I was involved with very large corporates, managing their treasury, managing public investments, and managing private investments as well through mergers and acquisitions. I was then given an opportunity to be part of a very large global buyout private equity fund, which effectively culminated with the global financial crisis of 2007-8. It's then which I realized that it's not always about the story of a sector or of economy. I think it's important for us to figure out if there are ways to protect capital and to ensure that we do not face a similar meltdown in our investment books as we saw in 2008, because that was a shocking event for global financial services and investments worldwide. And it almost has taken 10 years for global economies to actually come out of that recessionary environment. So sitting back in 2007-8, having invested a very, very large sum of money in private equity and in buyouts, which had melted down to negligible valuations, it set me thinking which is the best way to actually protect capital. And thinking about safety, I realized that there are two ways to do this. The first is look at debt as a product, because they are looking at a mortgage back or a assured return rather than any equity upside or volatility based returns. And second, within debt, what does one do? And that's really when I chanced upon mortgages. Now I realized that in India, the quality of mortgages is one of the best in the world. We have one of the most solvent mortgage books, and the delinquency ratios are less than 0.5%, which means if there is a way for us to actually discount mortgages in a running residential project, which is largely mid-income affordable housing, and it is obviously bought by first-time home buyers who are buying it on mortgages. And in India, the rules for mortgages have always been more tough and more stringent compared to any other mortgage industry worldwide. Very many people are not able to access mortgages, and even if they did, their own contribution tends to be very large. So that was the first sort of thought that came to my mind is, can we do this simple idea of discounting mortgages? Fortunately for us and unfortunately for financial markets, there was no securitization product or market in India way back in 2007-8. So we said, because of this entire collapse or global collapse of financial services and capitalization in the country, where banks have really stopped functioning, private equity has disappeared, and those are the only two modes of financing. There were no NBFCs, there were no other private funds. We decided to introduce this product, and I thought, because I've seen similar products internationally where I was involved in, which is in the nature of RMBS, which is a residential mortgage-backed securities. That was a synthetic product. I said, if you have to do a simple securitization, then that may work. That's when we started identifying projects which are well sold, well constructed, and need that sliver of capital to be able to tide over the completion crisis, which was percolated during the GFC of 2008. So we started capitalizing those companies by receivable discounting and issuing of bonds. So that was the first time in 2007-8 that NCDs in India actually were issued for the first time by real estate companies. There was no market till then. It was a very new product, so took us time to understand it, perfect it, and securitize it. But it had phenomenally great outcomes. We were able to completely ring fence our investment by completely securitizing the entire receivables by way of escrow of the bank accounts. We were able to take control of the entire project as a whole as part of the mortgage security, and which allowed benefits to both parties. The project company was able to get that very, very essential capital and able to complete and accelerate the project where there was no other means of capital available. And likewise, we were able to earn a very superior returns compared to what the mortgage rates were. Because obviously a remortgage industry does not allow much margin, but securitizing these mortgages in the hands of the recipient, which is the developer company in the escrow account, really made a lot of difference. So that really set up the tone for us to further this product and propagate it widely. Fairly many private equity funds or domestic funds started to realize this product and started to introduce this as part of the investment strategy and thesis along with us. So this period between 2007-8 to 2012 is really when this entire NCD or private mortgages or discounting business really blossomed to a reasonably large play. We were at the forefront of that business, and we are always very certain about our strategy, because having seen 15 years of challenges and cyclicality in financial services and investments, it was very important for us and for me to ensure that we kept our investment very tight and very secured. So it was never really about figuring out which new project to back. It was always about creating a cash flow based securitization product, which could always ensure that irrespective of the macro environment, irrespective of what happens in a geopolitical environment, that money will always come back to us. Because in India, once you've paid 30, 40, 50% of the money, every home buyer is excited, keen, and anxious, or even nervous about getting possession and paying that difference and paying the balance amount. So, therefore, irrespective of what happens globally or even domestically, that security is absolutely pristine in our minds. And we've been proven right over the last 15 years, Kritika. I'm very happy to see that whatever we decided then or whatever we discovered then has been proven to be absolutely solid. Mortgages and mid-income affordable housing buyers continue to be very, very solvent and diligent about purchasing, about paying and taking possession of their homes. So it obviously served that purpose. We obviously then saw that in 2012 the AIF regime came into being, and that allowed us to formally pool capital. Till such time it was done either through a PMS or in partnership with foreign funds and things like that, or people who had capital under different routes. But it was only in 2012 that we were able to actually get the license for an AIF, which was a new regime then, and pool domestic money. That's when we really launched the first fund. And we've been doing multiple funds since then with this singular idea that A, we will go after mid-income affordable housing. B, it will be all brownfield projects. That way we're not taking any risk that we can't manage or underwrite, which could be including title or approvals or construction or design or market acceptability or sales. None of that, because it's already a discovered product. It's already selling well. It's already got enough buyers in there. A significant portion of it is completed and sold. So the risk factor affiliated with a new launch has already been taken care of. Now it's only about ensuring that the cash flows from that project come back soon enough for us to effectively recover our capital. So that's really helped us, so that even when there were larger events, Kritika, whether it was a GFC, after GFC, a demonetization, or a RERA, or a GST, or even the Black Swan event of COVID, we've never had any challenges with our investment. So this whole idea that real estate can be a safe haven, and our grandfathers and our forefathers always thought if you have to invest, put in gold or real estate. Somehow, because of all this complexity of investing in AIF funds and investing in under construction and buying in all sorts of different formats, people did have bad experiences. And I said, how is that possible? I mean, we've as a legacy, as a heritage, we invested in real estate. There must be something solid about it. And that's absolutely true. So what's important is that you have to go back to the basics, and the basics of real estate are very simple. There's land which does not depreciate. I
Yeah.
have not seen any asset in India actually fall in value over time. It's only either remained flat or it's gone up.
Yeah.
Unlike we've seen bubble formations in, globally across major economies, whether it's in the US, whether it's in China or other markets where asset prices have actually collapsed. In India, fortunately, because we're underserved, we're under-constructed and under-delivered, we don't have that scenario where a product, let's say we're sitting in this beautiful studio with you in Andheri, and let's say it's selling at 24,000 today. It was at 12,000, 13,000. It's never going to go back to 5,000 bucks a square foot.
True.
It's
Yeah.
improbable, it's impossible, right? So that benefit we always enjoy in India, that asset prices will either stay flat or go up. I think that's a huge benefit for us. The second advantage I saw with real estate is that it's very fundamental in consumption. It's not a trading asset class. People are not buying to flip it and sell it and make money like a commodity asset. It's actually a consumption asset class even till today, and that's very important, right? And second and third most important aspect is the fact that if you look at any project or any development, even if it has got stalled and completes even in 10 years, there'll always be demand at a certain price. So there is no obsolescence of real estate. It's not like people are going to stop buying homes and say, okay, now we're just going to go and stay in hotel apartments, or we're going to stop consuming office spaces, right?
Yeah.
So it's very fundamental. And so there is no obsolescence issue. So whatever project you've invested, which is a good, sound project in a good city, in a metro city, in a key micro market, which is serving the needs of that locality and micro market and consumers, even if it is delayed but completes, it will always find value, it will always find monetization. And those are the fundamentals that we've always played on. So we've not gone into fancy DCF or cash flow based discounting valuation saying, oh, this is the present value of this project, and therefore let's give so much money to the promoter and reward him. Because that is not to reward the promoter for not completing a project. And so a lot of people have actually put out too much capital, which have rewarded the promoters or rewarded or created, I think, abnormal gains or incentives, which are contrary to the fundamentals of debt. So if you stay true to debt, and if you stay true to the whole idea of securitization, then I think that's a beautiful opportunity for everybody. And that's really what, so as we started dabbling in it, we saw successes. We saw more capital coming in. People were super excited where the interest rate regime was 10%, 11%, or 12%. We're able to generate a significant alpha because we're addressing the short term liquidity need in very well constructed and delivering projects. That created this whole euphoria that there can be an alpha in a credit product. You can generate equity like returns in a credit product. So it was a discovery by chance. It was maybe led by the GFC, and otherwise, honestly, if you ask me in 2007, would I be in real estate and doing this? My answer would be heck no. I mean, I'm very happy doing mergers and acquisitions or private equity or leverage buyouts, and I don't think I would do anything else. But just the fact that this crisis led to this thinking that how do we create solutions such that we do not foresee this problem again? Because it's very hard for an investor or investment manager when you've put 5 years of hard work to find investment opportunities, to curate them, to invest them, to and you're hoping that you make a large multiple or exit one day, and everything falls. It's very disheartening. And more than that, for me, it's even more relevant because as a manager, you're facing your investors, and then to go back and say, I'm sorry, it didn't work out, I think is disservice. Because when we've seen people go out and raise money, we've raised capital, there's a lot of stories, there's a lot of promise, there's a lot of good days are coming, outlook which is provided to each one of the investors who are willing to believe in your confidence. And because of either the product being not super enough or the environment not supporting your strategy, cannot be a good reason for us as investment managers to go back and say, I'm sorry, we didn't do it. So that was a very big driver for us. And again, India is a conservative nation. Of course, today with a lot of the new age products, people are willing to take risk. But I think savings is still a very large part of our economy. People still want to go back and save money, put it into fixed deposits, put it into banks. put into debt mutual funds, have a certain amount of fixed income in their hands rather than earn a multiple. And so, therefore, this product really, I thought, did very well for the Indian domestic investor.
Yeah, but the time you noticed the need gap and the problems, and the time you came up with the solutions, let's be honest, real estate that time was not an organized sector,
No,
right?
it wasn't.
And you defined a true meaning of what is an entrepreneur, because entrepreneurs looked at the problems and provide the solutions, and you did that during those times. How did you navigate through this unorganized real estate sector, and what kind of challenges did you face, and the lessons you learned that had shaped your approach when it came to the current real estate market, or even came to your leadership style?
No, very true. Great question. Of course, there's been a lot of introspection and a lot of learning in the last 15 years. And I've been very fortunate because I started this real estate journey and investing with Knight Frank as a director there. And I was given a fairly open rein by the management to try and do these products, try and do these investments. We, in fact, even did the first private REIT way back in 2008-9. Because I realized that it's a beautiful time to invest into pre-lease commercial assets. The valuations have fallen in 2008. People are happy to give away their assets at a discount. The interest rates had compressed because, like we saw in during the COVID environment, where interest rates fall whenever there's a global black swan event.
Yeah.
So interest rates were low and yields were high, which means I could borrow at 8% from the banks and I could enter into a pre-leased asset at 12%. So that's a fantastic time when you actually have a positive spread between the yields and the interest rates. I think that's the time to buy commercial pre-leased assets, especially if you're getting good valuations. So we built that book as well, and it was our first private REIT, and it did really well. And so I think cutting my teeth into real estate by a granular understanding of the markets, of the idiosyncrasies, of the regulations, which are so different and so varied from state to state, city to city, corporation to corporation, understanding the nuances to what can go wrong. If I'm investing, can I be stuck because of approvals? Can I stuck because of occupation of that premises? Can I be stuck because of non-compliance? Understanding the challenges is the first thing, because it's that really risk that you need to underwrite first. We understand that, okay, real estate is a fundamental asset class and the thesis all looks fine, but it's really the granularity which creates the problem. And many people actually miss that. They go with the thesis, they go with the big story. Let's invest in this big story. The problem is that the big story is fine, but it's really the gaps within that big story which create the problem. So I said, let's first plug those gaps. So let's understand the sector backwards. Let's meet as many people, as many investors, including people who lost money. A lot of money came between 2005 and 2008. Almost some 13-14 billion dollars came to the country, and people lost it. And saying, okay, there's something which has gone wrong. Okay, so GFCs may be one reason, but again, India is still a fundamental real estate country, and so it's not as if because of GFC the prices in Powai have fallen from 8,000 to 3,000. So how are people losing money?
Yeah.
They've invested in Powai, invested in good micro markets. It's something which has gone wrong. So understanding, so there's a huge learning that was available, fortunately for us, in 2008 because of the mistakes that people had done. We said, let's first figure that out and understand that we should avoid these at all costs. Then let's understand the idiosyncrasies or the nuances that people won't tell you, which is the technical aspects of the business. So today, as an investment manager, we pride ourselves in knowing the business backwards. So even if somebody tells us a story or tells us a hypothesis or gives us data, unless it meets our own internal diligence, our own understanding, we're completely satisfied that it has met all check boxes and we are ourselves convinced of the thesis, of the whole idea, of the whole math, we will not invest. It's not just based on what an agency tells us, what a borrower tells us. It has to be based on our own learning and understanding. So I think that's what some people have missed in the past. In terms of the way things have moved, of course, there has been a separation initially between the big boys and the not so big boys. So there were always tier one guys who started becoming bigger and who started consolidating even back then. And there were people who were mushrooming or were starting business or were mid-tier or not so great guys. But they were the ones who really needed this capital the most. So it was not really, because once banks started up, and of course we gave money to the big boys between 2008 and 9 or 10. But once the banks started up again, capital started flowing only to the big boys. like we're seeing in the current environment.
Yeah.
It's only available to the big boys, which means that there was still a very large market, because that time the organized market was barely 9%,
Yeah.
and 91% was fragmented and unorganized.
Mm.
Now, that's really where the capital is needed, which means you needed to be even more careful as to who you're going to work with, what is your counterparty worth, are they diligent about your capital, are they really, really uh, grateful for having got this money
Mm.
to be able to tide over their asset liability mismatch, or are they just looking for liquidity to do other things?
True.
So I think that was very important. So that's really what kept us true. And of course, we also realized over time that it's not an investment asset class. Real estate actually is an operating asset. What very many people think is that it's okay to lend money, you've got your mortgages, you've got your cover, everything looks good on paper, money will come back on its own. It actually doesn't,
Yeah.
because there are just too many leakages in our system. There's just too many ways in which capital or valuations can dissipate. And we've seen that, Kritika, in the last few years, starting from 2007-18, with the downfall of some of the largest NBFCs in the country, with the downfall of several large banking institutions, wherein underwriting was not strong enough, or maybe the monitoring was not strong enough, or there was a mismatch. And obviously, that's something which shouldn't happen, and that's something we are always cautious about. Is that monitor every day, monitor every week, ensure that whatever you signed up for actually comes to you. Okay, so whatever sales, whatever collection, whatever receivables, whatever construction has to happen because you obviously invested for that. Right, so that's very important. That, and which is why today we have one of the largest teams on per dollar invested in the country. A 24-member team running $100 million book. It's usually the reverse. It's a five-member team running $100 million book. So that's very important for us, is actually monitoring every asset, every cash flow. That's what keeps things tight and true. It's not just about distributing money, because the challenge is that it's a curated product. It's a job shop. Real estate is not a mass manufacturing environment where you keep on, having line manufacturing and the product keeps on rolling out, and therefore, quarter on quarter, how much a factory is going to build, how much is going to get sold, what are the markets absorbing. Every project is unique. It's a job shop. You're actually curating a particular product for a particular micro market, for a certain target consumers. And because it takes that much effort to actually create a curated product every time, it leads to a lot of disconnect or a lot of issues within the system of the producer, because they're trying to maximize their own outcomes with every product that they're going to build. So there could be a disincentive between what we want, or a disconnect to what the producer wants or the borrower wants. And therefore, it's very, very critical, because there may be nothing else after that. There may be no new project after that, or the next project may take some time. So then what do you have recourse to after this project is done and dusted? So that's why it's very important that you actually take control of whatever asset, whatever project you've lent to or invested in, such that the returns actually come back from that, right? So monitoring, so it's an operating asset class. I think we must make no mistake about it. And it's very different from what people have seen in global economies, right? Because there the systems are different. It's a wider, broader market. People are actually creating multiple projects, multiple assets concurrently, and each capital that is deployed can actually be recovered across the stream of cash flows or opportunities or projects. So that's not the case here. It's very hard for a developer to have 50 projects at a time. It's very normal for global developers to do that. So that's very, very, very important from my perspective. And so, Kritika, I started with two investment ideas way back in 2008. One was the credit product with receivable discounting in late stage projects. And the second was this whole REIT idea, private REIT. We didn't have REIT regulations back then, so we borrowed it from the Singapore REIT regulation and said, well, we don't have one, so let's try and figure out how to actually run a private REIT. And we did that in 2009-10. And that did very well. But then again, when the markets went back up, the yield curve inverted, which means that the cost of capital was higher and the yields compressed, which means we were like running into negative yield territory or negative spread territory. And I wasn't convinced that that's the right thing to do, where you're earning 7%, but you're paying 10%. Effectively earning net a lower amount, So I thought, therefore, leverage is actually not helping. And but of course, I think rental yield is a leveraged asset class. That's how you make your multiples, your returns. So we've really stayed away from that over the last 10 years from rental yield products because of this mismatch, which has been persisting for quite some time. Now, maybe for some time, it reversed. And again, it was a short period where there was an opportunity. But again, there's just too much capital flowing in, which means then again, you're looking at suboptimal assets. So, but we're again considering that. We think that because of the cost of capital being high and the need for capital also being higher, there are opportunities to actually get into leased environment, but with a different strategy. So that's something we're now toying with again.
Mm.
I think there's an opportunity in the shared environment space, where people are happy to collaborate in office spaces, happy to collaborate in common living spaces. And I think there's a huge opportunity in that space because it's still a fledgling sector from that perspective. And I think that's really where the growth is likely to be. So we're toying with that. So we've traditionally, as a person, I'm fairly anti-system
Mm.
or anti-cyclical,
Mm.
where I will go in when the markets are falling and come out when the markets are rising. So when there was too much liquidity in 16, 17, I
Yeah.
actually didn't invest. I said, let everybody rush in with their money to whoever they want to lend money. And we're very happy that we didn't because, we're seeing the problems that a lot of these books have had by having put too much capital to work in a very short period
Mm.
of time. We said we're happy not to get into this entire froth. So it's always about being counterintuitive. It's about thinking what others are not thinking, or
Right.
seeing what others are not seeing,
Mm.
because everybody's seeing, the challenges or the opportunity right in front of their noses, and seeing what lies beyond that.
True.
So I think that's just how I've been built, and that's how we would do our business.
So coming back to your statement where you say, I see things beyond that. In Indian real estate market, we have also seen a bit of downfall of few developers where they have promised certain projects, where they have promised certain, possession date to the home buyers and but have fled away, and the home buyers are left in despair to get that house and go in courts and everything. Of course, now because of the RERA, a lot of policies like these have made a boost to real estate, but also to help the consumer point of view. I'm trying to understand from you, when you guys invest in stressed project, what kind of key factors do you keep in mind while evaluating such projects? Because earlier what we had seen, where these private funding was coming in for the help of the developer project to get, completed, that kind of funding was used for other projects by the developer. Those kind of malpractices were happening. How do you make sure such things are also avoided? Of course, now there is a escrow account and everything, but what do you keep in mind before taking upon the project?
It's a fantastic question, Kritika. I think it's always to do with the opportunity and the intent,
Hmm.
both. So
Hmm.
there's the soft factor and the hard factor.
Hmm.
The hard factor is a very simple analysis as to what went wrong and is it because of intent. Now, if there is a stress, it has been percolated because of certain factors. It could have been market, or it could have been regulatory, or it could have been because of failure of one of the stakeholders. And that's okay because there was no misintent there. We
Hmm.
didn't know that this is going to happen. Or it could be environmental, right? And I say market or environment. So, which means that there was a black swan event, or there are certain regulatory changes which happened, which stopped construction because of NGT or because of certain issues
Hmm.
that the governments or the regulators decided must be surfaced or dealt with, because which everybody was affected, and that project also got affected. So those things are understandable because fundamentally the idea is still solid, the intent is solid, but there are very clear, definable events or issues which were not forecasted, and nobody could have forecasted that. It was not a problem with the promoters or the project itself, but it has affected a large number of people. So that's okay, right?
Hmm.
Because you still started with the right assumptions, you started with the right product, you started with the right idea, and you ensure that you worked on that and you tried to deliver that product till such time those events started panning out and it disrupted the project.
Hmm.
So now that if those issues are solved, and the issue is only capital, which means the regulatory issues are solved and the environment is back normal and everybody's able to start work again, or whatever those issues were, have been sorted, and now the need is only money to now effectively complete an exit, there's no problem,
Hmm.
right? But if the issue was intent, because there is no equity left in the company, monies have been taken out, so now there's no incentive for the promoters or the stakeholders to actually complete it, because even if they did, all the money is to the bank, then obviously that's not the right product for us. So we have always been very, very selective. When we looked at about 500 investment opportunities last year. We only did 12. So it's very important to identify the right partner, the right counterparty, and help solve a particular cash flow issue wherein the interest of all stakeholders still remain aligned, which means the home buyers are still with the project. They're not trying to take down the developer. The developer has made all endeavors to ensure that he's able to communicate to the home buyers. These are the issues because of which I'm unable to complete and I'm trying to solve it. And he's made extraordinary efforts to try and address it and still keep things in motion, which means the intent is demonstrable. And there's enough skin in the game of all stakeholders involved, whether it's the promoters, whether it's the buyers, whether it's the landowner, everybody's still aligned and they want that thing to happen. If only I want it to happen as an investor because I see a profit, then I'm fighting against the tide because nobody else wants it to happen. That's a bad idea. Money itself can't solve everybody's angst or issues. But money is only a plug. So long as that money is acting as a plug to actually complete the jigsaw puzzle. Otherwise, it's all looking still good. There's just one piece, which is money, which is missing. The moment you put it, it looks perfect. Then I'm okay with it. But everything is in a disarray, and it has been, it will continue to be in a disarray. Then that's something which that piece can't plug. So I think that's the first and foremost. Second is, and therefore, what really goes down is how much time you spend behind in every investment opportunity. We spend 6 months sometimes at a go, trying to understand the promoters, understand the micro market, due diligencing the customers, due diligencing if there are any issues, cases, litigations, or any other, things that we may discover formally or informally about the concerns that may be existing for the project or within the stakeholders of the market. So I think once all of that process is done and we feel, well, there's nothing really which sprung up at us. It's a genuine issue.
Yeah.
I think then that deserves our capital. Because we're not trying to create a very large book. Let's be a $5 billion fund. That's a problem, I think.
Yeah.
India doesn't have the debt. We don't have the opportunity to put $5 billion at work in a year in our country. It's still a shallow market.
Yeah.
We're still trying to build. We're still trying to create large companies. What one company in one of the major economies sells in a year, our entire market doesn't sell in a year. So that's such a stark difference. So obviously we have to be very careful. I believe that even if he can put 200-300 million dollars to work in a meaningful manner, I think that's good enough for us. We're not trying to put too much capital to work because I don't think it's easy for anybody in the country, or there's any balance sheet strong enough which can actually take too much capital, especially which is in the nature of debt, and return it back in time with the requisite returns that we ask of. Because it's private money, it's not bank money, it's not deposit money, it's not cheap capital, it's expensive money. So if anybody's taking too much expensive money for a longer period of time, there could be challenges which will erupt, even if we don't know what they are, because we didn't know what they were 5 years ago. When we're now looking at something which is broken, we're trying to fix it. It can again get broken 5 years later. So long as the money is short, it's tight, it's for a small period of time, it helps solve that problem quickly and gets out quickly, I think we're in good hands.
But help me understand, when you filter out the stress projects, as you said, last year you invested in 12. So when you filter one project, let's talk about one project. Like recently, the project that you invested was 24 crore in that Gurgaon project, right? How do you make sure, or how do you monitor that working capital that you provide to that stress project?
So this is why I just mentioned some time back that this is an operating asset class, and we've always dealt with it like that, which means that I need to know every variable, and we need to be able to control all of that ourselves or have a view on that. So even from day one, when we started actually crafting our documents, we always had this mechanism of escrow control. We always had this mechanism of having a PMC on site. We always had the mechanism of actually implanting a CFO on the project who can actually monitor daily cash flows and take control of accounting, taxation, and other statutory and cash flow liabilities or controls. So I think that is something which we had as a discipline from day one. So it's not something which people are maybe discovering today, or they're saying, "Oh, by the way, we're doing this today." We've been doing it for 15 years. So I think that's very important, because when you realize and when you recognize this is an operating asset class, you need to plug yourself in as a lender into the project as if you're a partner in the project. So even though it's a loan, but a loan left by itself, can create an issue. It must be monitored. And it doesn't matter who the counterparty. It can be
Hmm.
the largest, the biggest, the
Hmm.
bluest, or it can be the smallest and the most undiscovered or unknown character. It is irrelevant. I think the most important part is us knowing what is happening and what can go wrong, which
Hmm.
is why, because we're able to do that, we
Hmm.
know way ahead of time that there is something which is not going right. Cash flows are slowing down,
Hmm.
construction is slowing down, collections are not coming as forecasted. So you know there's something which is going amiss. So
Hmm.
before it becomes too late, one is able to actually step in and take corrective action.
Hmm.
Okay, what is going wrong? Are you not able to collect? Is there a concern? Are people not wanting to buy? Are people
Hmm.
not wanting to put their balance money? What is the problem? How are we going to solve it? What is it that we're not, what is it that the project is not doing right, which is supposed
Hmm.
to do? So all of these questions start getting deliberated upon, and we try and find a very quick solution so that it goes back up to the cash flows and the business plan. So it's
Hmm.
very important that when you actually, because see, when I started by saying it's a securitization product, there is a predictability of cash flows,
Yeah.
and that prediction is already set up upfront, that if I'm putting 100, I need to receive 150 or 140 in, let's say, 2 years.
Hmm.
To get that, I must know what is it that I'm going to get every month, every quarter. And if there's any slowdown, it's obviously going to affect the repayability at some point in time.
True.
So the ability to actually plug that very fast and take corrective action is very critical.
Hmm.
So that's really what we've been doing is, and that's why you need to know the market well. You need to know what consumers are saying. You need to know
Hmm.
what brokers are saying. You need to know what buyers are thinking. You need to know what the regulator is thinking or saying about a particular project or a micro market or a developer.
Hmm.
What are the issues that the developer is facing at large? Could not be in the project, but could be outside of the project.
Yeah.
Could be elsewhere in something else. So
Hmm.
I think keeping that eye open, keeping your ears to the ground,
Hmm.
understanding what shocks are likely to happen at some point in time, because
Hmm.
the tremors are already being felt, and taking corrective action before that is very critical. I
Hmm.
think that's where, operating it on a regular basis, knowing what's happening is, I think, the only way one can actually stay completely secure and safe, because nobody's going to tell you the bad news today.
Yeah.
No borrower is going to tell you the bad news today.
Yeah.
He's going to keep it in their heart, and when it comes, he says, "Oh, by the way, this happened. Now let's find a solution." And
Hmm.
that solution may not be something that you like,
Hmm.
but you have no choice but to accept it at that point in time.
Hmm.
So it's better to actually preempt all of these things ahead of time.
Hmm.
So that's what we've always maintained, that if we cannot be in a role,
Hmm.
even though we're lenders, and a lot of borrowers say, well, you're a lender, you will get your returns, why do you worry? I
Hmm.
said, well, if that was the case, then I would be sitting in the bank. I'm not sitting in a bank.
True.
Or I'm not sitting in the NBFC where my job is to only dispense money.
Yeah.
My job is to ensure returns. I'm in the business of generating returns, not dispensing capital. So if we are able to agree the
Hmm.
fact that we can plug ourselves into your system,
Hmm.
and you're willing to be transparent and you're willing to have everything disclosed like you would know yourself or more,
Hmm.
then I think we're the right partners. So I think keeping those sort of check boxes and cornerstones is very important, and we've always done that. So people who've actually not done that, up where monies have gone out, the project has suffered. People have tried to sort of have money circulated across multiple opportunities without ensuring that one guy gets paid. So I think that's a common problem, because that's also been the bane of real estate developers, is
Hmm.
that capital is limited, opportunities seem large.
Yeah.
So with that limited capital, how do you spread your bets? That's really
Hmm.
when you start to sort of move capital around, and sometimes knowingly, unknowingly, people do agree to it.
Hmm.
That okay, I mean, there's enough cover, but cover is just a number. I think it's about discipline.
Yeah.
It's not about mathematics alone. It's not just about metrics alone. It's
Hmm.
not about saying whatever I underwrote is still being maintained. It's about the discipline. It's
Hmm.
about the intent, both at the lender's end as well as at the borrower's end. So we've always recognized that before we've recognized the numbers.
So I've seen few developers projects, where they have taken help from L&T and L&T has finished the project. But what do they have said is that during the end, for example, if project is getting end in 2 years, they have to make sure that they pay the L&T guys. If they don't, by the end of the 2 years, when L&T has finished the building, they take up the project and sell it according to their, by putting the ticket prices and all. Why I'm talking about this, to try to understand when you are going through these stress projects where you're providing the working capital, there might be times where you would have seen during the where you say that we find out the problems, but finding out the problems also, there are times where you can't find the solution. Sale हो नहीं रही है तो it's not selling, right? आपका unit नहीं बिक रहा है. So then what kind of exit strategy then you do, and how you make sure your investors' money is intact?
Good point. So those cheeses. First of all, it's a running project where fundamentally it must be a project that the market likes.
Hmm.
Okay, and that is demonstrated by the sales MIS. So when you start looking at data, you say, okay, you launched the project in year X, and now it is X plus 3 years. Where are you? So, and how has the market behaved with your project? How many walk-ins came? How many people actually bought? How many people are now
Hmm.
existing buyers? How many people are looking to exit because they don't think this is the product they like? So, purely from historical data itself, one can find a significant amount of behavior
Hmm.
or attraction for that project. What has the consumer really? Having said that, of course, preferences of consumers may change
Yeah.
with time, right? So there's nothing wrong with the product 5 years ago, but today people don't like that product. They like with more amenities, they like larger spaces, whatever that may be. So that's really when we do a dipstick with, let's say, a group of brokers or sales agencies, that if we were to give this project to you and there's X amount of inventory left to sell, what do you think is going to be the outcome? Now, these are people who sell the maximum amount of inventory in any city.
Hmm.
So we'll actually call them in and we'll have a focused group discussion saying, let's go out and find out and tell us what do you think. So, and it's a very high probability that the guy who gives me the best answer will actually walk away with the mandate to actually sell the balance inventory.
Yeah.
So there's an incentive built in for them saying, and we've done that in a lot of projects. We've actually appointed these agencies or mandate holders to actually sit on the site and ensure,
Hmm.
basis the analysis, basis the segmentation, basis the demographic profiling or the consumer surveys that they've done, that this is what will happen at this price point. That's what we agree then upfront with the borrower, that this is what is going to happen. You may have to discount the price. You may have to create a certain payment plan. Whatever is it that the market is telling us today,
Yeah.
you will need to implement those strategies upfront
Hmm.
so that we're not then left to fight or discover later
Hmm.
what we should have done prior to investing. And fortunately, Kritika, things don't change that fast. It's a 5 year cycle,
Yeah.
which means that consumer preferences, locations, micro markets, consumer behaviors will alter a bit, but every 5 years. We're not there for that period of time. We're trying to exit much sooner.
Hmm.
And if a product is decent, meets the demands of the consumer, the home buyer in that micro market, at some price it will sell.
Yeah.
If I'm in Andheri and if something is selling at, let's say, 28,000 or 34,000, but I have a three times cover, which means that till such time that it sells at 10,000 rupees, my capital is protected. Will there be a buyer at 10,000? Of course there will be, but I don't need to sell it at 10,000. I don't want to make a loss for the shareholders and the promoters. But maybe it'll sell at 22,000 also,
Hmm.
if not 28,000.
Yeah.
Because maybe it's not as glamorous or as overspec the product as what the next door guy is building at 28 or 30,000.
Yeah.
But my product, so there'll always be a demand. And I think that's very fundamental, that because the consumers are so large, the demand is so large.
Hmm.
And if it's a core product, if it's a product that people actually want to stay in, okay,
Hmm.
it's not a penthouse, it's not a service apartment, it's not a fancy asset, it's actually a core housing asset, it will sell at a certain price. So we've already done that discovery ahead of time and we've ensured that those systems are at work. And we always have a plan A, plan B, plan C. So plan A, this guy goes out and sells that much balance inventory, and the rest of the receivables are anyway coming from from sold inventory. Because we've also, by the way, gone and checked with the buyers: are you happy? Are you likely to pay? Or are you likely to cancel once we step in, or are you going to have a problem?
Okay.
So if people are happy that no, please go ahead and complete this project, we
Yeah.
want possession. We're not here to cancel.
Hmm.
We're not here to recover extraordinary amount of profits from this project. We actually want this because when we invested, it was X. Today is X plus 40% or X plus 30% price.
Right.
And I'm not going to cancel and try and pay 30% more to buy another apartment. I really want to actually stay in this location.
True.
So then that is a fundamental issue.
Yeah.
And that's really what we're addressing. We're not looking at speculative developments. We're not looking at speculative outcomes. We can't have that.
Hmm.
The whole idea is that it must be fundamentally, it must be rooted, it must be discoverable, it must be demonstrated, it must be proven. When you have that, then there can be no reason why it can go wrong. So
Hmm.
yes, we've asked people that, okay, by the way, you think that you sold at 18,000 today, but you sold it 2 years ago. 2 years you had a gap. Today market is 24,000. Sorry, I don't think you're going to sell at 24,000. Let's keep 20,000.
Yeah.
Let it be a 15-20% discount to the market. At 20,000, market is there.
Hmm.
So that understanding has to be very clear with the borrower that this is a cash flow business. I'm not here to maximize my profits. I'm here to actually exit this project. Because the problem of not exiting in time is far greater than the
Yeah.
profits you might make or might not make if you have to hold on to the inventory
True.
at a certain price point. So once there's alignment that this
Mm.
is a cash flow issue, we need to plug it. We need to ensure that cash flow start, and I need to complete and exit and deliver. Then I think we're on the same page. I don't see a challenge with that. And again, so what are the challenges really? A, it could be the product is really bad.
Yeah.
We already know that.
Mm.
So a lot of projects come to us, Kritika, where 60-70% complete, but zero sales.
Mm.
I'm like, Bhaiya, kya kare? Why are you not selling? And
Mm.
why? And you're stuck and you want us to help you out? No, no, sir, when it completes, we'll sell at 2 times the price. I said, then that's for you to take home. And I think it's for you to stay. It's
Yeah.
not for the market. Because what is not selling, what is not sold, is not something for me to discover.
Mm.
It must be a selling. And that's the advantage we have that today in India, we always have off plan sales.
Yeah.
Residential is a off-plan sales market. Unlike in many mature markets where you need to complete and then sell,
Then sell. Yeah.
we don't have that problem here. Which means you can actually discover demand, you can discover price, you can discover consumer behavior very early into the cycle. Upon launch at ground level.
Yeah.
So you can't tell me 70% completion later that I'm waiting, the demand is crazy. People
Mm.
are actually begging to buy this product, but I'm not selling. I'm like,
Yeah.
there's nobody
Yeah.
big enough to actually hold on to resi inventory of such
Mm.
great value, for 4 or 5 years. So I think it's very clear that there must be a market, and that market must be known to us. Who's the buyer? Who's the consumer? And when you look at the data, you already know these are the socio-economic segments, these are the communities who are buying, this is the locality where more sales are happening. So you already know the pattern for that project.
Mm.
Then you try and extrapolate it. Then you do a little more market research, which is why we spend enough time. When you spend enough time, you already know the answers. And fortunately, the answers won't vary too much.
Yeah.
There's enough margin of error built in into our assumptions.
Mm.
So I think we are therefore fine because the actionable points are already set out in the business plan.
So as we were discussing before about that recent investment you guys did in like 24.5 crore in Greater Noida, and there's a partnership with Swami Fund with that. What went behind in selecting that particular project? And tell us about this partnership. How does it fit in your strategy? And what did you come up with the kind of filter you have as we spoke about? What factors made you attracted to this project?
It's a very interesting investment, Kritika, and the first for us, honestly, of this nature.
Mm.
In 2021, when Swami was instituted as a federal fund backed by the Ministry of Finance, its objective was very clear that it needed to capitalize and help projects so that the home buyers which were stuck because of capital issues could actually see the delivery of their homes.
Yeah.
Now, that's a very powerful objective because the sole intent of this fund is to ensure that the project completes in the fastest period of time and people get possession. When you look at that scenario, and if you were to invest, for example, with Swami or in Swami or any
Mm.
other format, you know for certain that the project will complete.
Yeah.
Now, when a project is complete, there is significant value that is got unlocked. Whatever people have bought will get their homes, they'll pay their balance money, and there will be ready inventory even if it is not sold. Now, that has a certain ascribable value because it's an OC ready inventory in a market that is good.
Mm.
So that's the first thing we saw is that the outcomes are absolutely finite and determinable.
Mm.
So all if he did was ride with Swami,
Mm.
then we know that the project will get delivered. There will be a certain value which will get unlocked, which is available to people, to all stakeholders. So let's take a percentage of that value for ourselves. So the challenge, and of course, as part of the mandate, and rightfully so, Swami cannot take out an erstwhile lender. They cannot discharge a loan. They cannot refinance somebody.
Yeah.
Their objective is simply to put money into completing the project alone and ensuring it using all mechanisms and checks and balances that happens within an ascribed time frame. So the problem statement, therefore, is that who takes over the existing lender? Because unless the existing lender is discharged, that project is not free to take new capital.
Yeah.
So that's really when we started deliberating. And how do we partner?
Mm.
So we then came up with this formula that, okay, if there's enough value, then it makes sense for both of us, right? Because there's enough surplus. That's the first thing.
Yeah.
Second, which micro markets work for us? Of course, Swami's objective is pan India. Our objective is not pan India. Our objective is key micro locations in key mega cities or metropolis locations, and NCR is one of them. It's
Mm.
NCR, MMR, Bangalore, Chennai, Hyderabad, because these are large consumer, very large consumer bases.
Mm.
Which is why we see millions of square feet being developed and delivered by some of the largest names in the country in these micro markets. So we said, well, this is a large consumer economy, large consumer real estate market, and the purchases there are all by mid-income affordable guys who are stuck to receive their first home. So again, as I said, it's discovery of intent.
Mm.
Is the intent right? Was it right? And if it is right, then what is the solution? And where is the problem lie? The problem obviously lies because maybe a lender is not able to support a project, or there has been a capital mismatch with an existing lender, which obviously we've seen that it had gone to insolvency. It has
Yeah.
now got resolved. Somebody else has taken it over, and they're more than happy to resolve this asset. So now that solution with that lender is available.
Mm.
Now, if that solution is available, then we're happy to actually be the solution to that problem, where we can take over the loan and we say, okay, now Swami can put in 4 times the amount of money that we've invested to exit the lender to actually complete that project. So the surplus that is generated is available to us.
Mm.
So I'm certain of my outcome irrespective. Now it's a question of time. Will I get my surplus in 2 years or 3 years or 3.5 years? But even if I got it in 3.5 years, the surplus is large enough to cover my capital multiple times. So my capital is secure because Swami, as a federal fund,
Yeah.
is delivering its objectives
Mm.
and very stringently.
Mm.
So I think that's a beautiful solution. And I'm actually quite proud and amazed that nobody else is doing it. And we've actually found this partnership
Mm.
because there's no better safety in actually investing in a completed asset.
True.
So that was the first part. Second is, how can we ensure that we still see some liquidities? And then there are formulas. Is there a surplus asset that we can monetize and we can get in our favor, which is not forming part of the project? Can we have some cash flow sharing during the term of the investment because
Mm.
there's enough cover? So even if there is a top line sharing in our favor as co-lenders, then obviously that services our capital as well. So then those are fine tuning issues.
Yeah.
But fundamentally, I thought that because it's a cheaper capital, therefore, even if our capital is expensive, the blended cost doesn't hurt the developer who anyway was borrowing cheaply or at the right market price in the past.
Mm.
So as a blended cost, it is actually quite affordable. It does
Mm.
not impair the margins of the project. Second, as I said, because the Dictator Swami also is very, very aligned with the way we look at things. There must be high skin in the game, which means there must be enough promoter equity. If not, they'll ask them to put more equity. There must be no issues with regards to approvals. All
Yeah.
approvals need to be in place. So they're not getting stuck because approvals are not going to come. Because the objective remains we need to deliver and complete and get OC within a finite period of time. Third, there are no disruptions with regards to RERA cases or
Mm.
consumerism, or the whole matter is headed towards NCLT or insolvency. So all those issues are not there, and the
Mm.
people are aligned, the stakeholders are aligned. So a
Mm.
lot of the check boxes for Swami was exactly similar to what we were wanting or what we were doing.
Mm.
So there was a natural alignment because of that. That
Mm.
what they want and what we want is same,
Yeah.
which means the kind of projects I will lend to and what they will lend to is same
Mm.
or similar. So therefore, it creates better partnership because then, because of the cost of their capital, because of their ability to actually provide extraordinary amount of money to ensure the project gets completed, I don't have to worry about the end game in those projects. So that made it very easy for us. So which
Mm.
effectively we're just riding along.
Yeah.
So they're the big wave which is going to all carry us ashore
Mm.
without a doubt, because it's a big
Mm.
ship,
Mm.
and that big ship is a sovereign ship. So it's all monitored by, by the federal government and by the ministry. So I think that's a very, very strong partnership to have. And I think that really made a big difference that if you're going into NCR, into a project where a lot of people have had problems in NCR,
Mm.
but because this is backed by Swami, and we've seen outcomes. They've invested in a few other projects in that micro market or in that vicinity, and we've seen the outcomes of those projects. Phenomenal. The projects are getting delivered, the prices have gone up, people are more
Yeah.
than happy to pay. Balance sale has actually shot up because everybody knows now it's a Swami funded project.
Yeah.
So it's seen those examples in
Mm.
that same vicinity.
Mm.
So this couldn't have been any different. So that really inspired a lot of confidence, saying, okay, why don't we go and do this? And that partnership is now continuing. We're doing more such investments where we're taking out the lender, we're partnering with them, and we're figuring out, or we have formulated ways so that we also get paid while they're getting paid. So that we're not waiting for necessarily 3, 4, 5 years. We're also seeing our liquidity and they're seeing their liquidity.
Also, your recent investment in, the Trescon Group plotted development, I wanted to understand what potential growth did you see for this particular project, and do you see any potential growth happening in Tier 2 cities or non-metropolitan cities in India?
I was never certain about the outcome for tier two cities because the markets were smaller, and we always data point suggest that 80% of the sales actually happen in the 8 cities of India, right? And that's what when you pick up a research report, you see these are the 8 cities, this is what they're performing, they form 70, 80% of the market share. But when you start actually spending enough time and when you start seeing trends, a lot of cities are now emerging as top cities. So there's a lot of research out as to which are the 10 richest cities. And we need not be Mumbai, it'll be actually a Surat, it'll actually be in Indore, which are the cleanest cities, which are the fastest developing cities. So when you start studying the trends there, we realize that there is an extraordinary amount of change which has happened in the consumer behavior in tier two. They're no longer necessarily wanting to stay in independent villas or bungalows or plots. They're happy to actually go into high rises and group housing. Live like people live in Mumbai or Delhi or Bangalore. I think that's a big shift, especially with the Gen Z and the next gen.
Yeah.
I think this whole nuclearization has also happened now in tier two, tier three cities. It's not limited to metro locations alone, which means that people are looking as families expand at newer assets, at modern assets, at ability to build their own homes. And there's enough and more liquidity in these cities because for them, real estate is a prime investment asset class. Unlike in metro locations where we'll dabble with crypto, we'll dabble with venture debt, we'll dabble with so many other asset classes, we'll put in stock markets, and we'll be asset light. The tier two, tier three mindset is still very asset heavy. I want to invest, I want to own, I want to have my own space. Now, that liquidity which has got generated and is sitting in tier two, tier three is very large. So, when you start studying consumer trends, especially within FMCG companies, then you start to think, what am I missing? If the largest sales for FMCG companies and online sellers is actually coming from tier 2, tier 3, there must be a lot of demand and liquidity. So when you start actually discovering that and going to some of the best cities, which are not necessarily the top 8 cities, you actually start seeing these results. You start seeing data points, you start seeing projects. And that's really when we decided last year that we will actually now foray into tier 2, but slowly. Because we need to have the same confidence, the same information, the same amount of engagement with these cities like we have with the top 8 cities. Like we know them backwards, we must know them backwards. So we started studying them, understanding Ahmedabad, understanding Indore, understanding Nagpur and Nasik, understanding several other cities, and figuring out what is it that we can do here because clearly the markets are super vibrant.
Yeah.
Super vibrant. I mean, product is selling at a far greater pace there than it is selling in metro locations. So we said, let's take this call that it's, and again, it's again about being anti-system. It's about being creating a differentiation for our investors and ourselves, about stepping away from the crowd and not falling into that, into that race. And that's really where this untapped potential lies. Because the top investors, the top lenders, the top funds will still continue to work these 8 cities. So now today, as a domestic fund, has the opportunity to go into a different backyard and say, let's look at this. So when you look at plotted development, again, it's a no-brainer business, especially in many parts of the country. When you look at South, when you look at North, when you look at even MP, plotted development sells like crazy because everybody wants to own a piece of land that they can eventually build and stay in. And when you actually look at one of these largest colonizers in Indore, when you say, okay, these are people who actually set up the city, who've done, millions of square feet. And when you see a nice curated development, which all the necessary amenities that a new age buyer will want. You've got a clubhouse. It's not just plotting and selling. You've got the clubhouse, you've got the amenities, you've got a nice gated community, you've got the landscaping. It creates a great aspirational demand. It's not just an investment for the future generations to monetize. It actually is an aspirational asset now. So I think that's really what drew us. And of course, there was enough track record of enough of these projects having been built, sold well. And so there's an extension of this demand which we're trying to fulfill. And that made tremendous sense. So a very small amount of capital actually creates a multiplier effect in tier 2 cities.
Mm.
Unlike in metro cities where you need too much capital because the land is so expensive, the
Yeah.
construction cost is so high, the selling price is even
Mm.
obnoxiously high. That's not the case, right?
Mm.
So while the wealth levels or per capita income in tier
Mm.
two is actually quite high, the consumer spend on real estate as a percentage of their net worth is actually much smaller.
Yeah.
In 5 crores, you can actually buy a lavish residential
Yeah.
apartment in any tier 2 city. You'll
Mm.
maybe afford barely a 2 BHK or 3 BHK in Mumbai.
Mm.
You'll have a 7 BHK or a penthouse
True.
maybe in those cities. So it's amazing, that
Mm.
what real estate can actually do, and how it can be afforded. And that's a great story,
Mm.
which people haven't really tapped. So I think that's really when we started to foreign. We're taking these small steps.
Mm.
We've now gone to Ahmedabad. We put about 100 crores to work there.
Mm.
We've gone to Indore. We put 25 crores to work there. We're putting another 40, 50 crores to work in that city.
Mm.
So as we start discovering these cities, we start understanding the consumer trends. And again, more importantly, I think it's about maturity. Earlier, because it was localized business with localized players and localized consumption,
Mm.
the need for governance was very less. You could start a small project, you could sell it locally and do it on your terms.
True.
Today, as the market expands, it matures, and there's consolidation happening across the country, I don't think it's no longer a localized play for anybody.
Yeah.
I'm in Ahmedabad and I now see actually some of the largest developers talking about taking global capital, taking private equity,
Yeah.
something they would hate. They don't want somebody else sitting on the book. But today they understand and realize that the potential is so much larger, and the fact that they can actually consolidate the markets in their favor is so much larger that
Mm.
unless they partner with blue blooded people, with institutions, with financial institutions and investors like us, they will not be able to capitalize on this opportunity by themselves, by local money, by local play, by local demand alone. They
Yeah.
will need that firepower. I think that is what is allowing these companies to transform. If,
Mm.
where we've invested or where we are investing, they've already transformed. They're demonstrating they have the necessary governance, they have the necessary systems, they have the necessary people and resources and systems to be able to actually take institutional capital and do what is necessary to ensure that we have complete line of sight and understanding of every step that is happening into these projects.
So the recent report by Anrock indicated some positive trends when it came to luxury premium homes in MMR, and we saw a 13% increase in the unsold inventory of budget homes. So, what would you foresee and what do you predict when it comes to MMR regions? Are we seeing luxury homes being investment more getting increased and the affordable homes going to go out of the market? Especially are we when we are talking about the MMR region?
I don't think affordable housing can ever go out of flavor. It is a very core product, and not very many people in our city can actually invest more than 70, 80 lakhs or a crore of rupees to buy an apartment.
Mm.
And there's only so much travel that you will do in a day to go to home and office and back, right? So I think that demand is prevalent. Obviously, because of various reasons. One, of course, being the large creation of wealth post lockdown, with the stock markets, having rebounded in a very large way. A
Mm.
lot of new capital inflows, a lot of M&A, a lot of buyouts. There's a lot of liquidity that got created in the hands of very many people, especially within the IT sector, within the stock markets, and within several other people who were exiting their businesses at a profit,
Mm.
that their ability to actually buy these assets, especially obviously the realization that I need a comfortable dwelling which can sustain me during another such black swan event, was anyway a prevalent force across the country. So that obviously tilted consumer behavior in favor of larger areas and more luxury dwellings. But it was also to a large extent determined by the whole taxation fact, which obviously has got plugged in this last budget,
Mm.
where capital gains are now limited to a quantum of 10 crores, right? So any purchase above that will be subject to maximum taxation rates, and there's no capital gains benefit beyond that.
Mm.
So because of the capital gains issue as well, that was one of the bigger driving forces, which is why, and Mumbai being the capital of financial services, and the generation of capital gains has possibly been the highest in the city. That's really where a lot of purchases happen in that segment, driven by both these needs: a to get into better spaces, and of course to also get the dual incentive of tax benefits. Now, with that gone, I think the market will normalize. See, because the luxury segment still is about 3-4% of the market. and there
Mm.
are only so many people who can buy that. So anybody who believes that this trend will continue and that larger luxury homes will continue to get sold in perpetuity, I think is going to be in trouble, because we've seen this enough times in the past. We
Mm.
saw that in 2009, and also right after the GFC, everybody said only luxury will sell. And then suddenly luxury stopped.
Yeah.
15, 16, everybody went back to affordable housing.
Mm.
But affordable housing guys have never had a problem.
Mm.
Luxury guys have had a problem. We've seen stuck luxury projects for years.
Mm.
We've not seen so many stuck, especially in MMR or in core locations. Let's say in Bangalore, where affordable housing projects have got stuck. People do end up completing it, selling it, and getting out very, very quickly because the demand is very high. That's the bulk of the demand is the MIG, LIG segment. So I don't think there's any problem that. Yes, the configurations may look slightly different. So today a studio may not work.
Yeah.
You may want a 1 BHK
Mm.
or 1.5 BHK, so that you have enough space, because still we have hybrid working systems. So not everybody needs to go to office every day still, and so therefore a little space so that people can have their own sort of den to work out of.
Mm.
Have their own privacy, have their own distancing. I think that continues to be a dominant driver. That you don't need to be in cramped spaces. If you can actually put out a little more capital, you can save a little more. You can ensure that safety net for yourself. And I think this whole 2 years of lockdown has really created an indelible mark on
Mm.
consumer behavior, that we cannot stay in cramped spaces. If we can afford it, or if we have the potential maybe to afford it, let's try and make that extra effort to actually, get into a larger space. So I think that remains. But having said that, doesn't mean affordable is out. I am a very strong proponent. It will come back. Of course, it's also driven by interest rates.
Yeah.
Today, when the mortgage rates are at 8 and 9 and 10%, it's very hard for somebody who's already buying an expensive apartment to also pay very large EMIs. So I think it's driven by interest in a very large way. So
Mm.
once there's a reversal of the interest cycle, and it has to happen, at some point in time, I think we'll see the emergence in a very strong way of mid-income affordable housing come back. See, because today those who are agnostic about interest rates are going to buy. I don't mind paying 10%, or I can pay on my own capital. I'm a
Mm.
self-funded buyer. So that's the segment which is obviously very prevalent. They're insensitive to interest rates. But the larger population is obviously very sensitive.
Yeah.
Every 1% can actually cause a significant impact on the net savings available to the consumer. And that's something which is obviously going to drive home buyers, away from the market till such time the interest rates come back.
Mm.
Also, one of the bigger concerns as to why there's been a dip in affordable housing is also because some of the incentives which are available under PMAY and some of the other
Yeah.
affordable housing schemes have gone away. Where I could get a discount, I could get a rebate, I could get subvention schemes, I could get discounted home rates. All that is gone, which
Mm.
means now I really need to be able to afford it myself. So while people are building up that strength and that
Mm.
demand remains, I think once the interest rates soften, I think that will certainly come back in a very big.
So we have noticed, and I'm sure you must have noticed because you've been in this real estate domain for so long, the finance investment evolution has been changing. Now we are seeing fractional ownership also coming in. What is your take? Share the journey that has gone from start till now, and what is your take? What future are we seeing when it comes to investment in India, especially for Indian real estate?
It's a very interesting time, because there was a CRISIL report which talked about the financialization of India Inc. As to how people are getting into digitization and
Yeah.
financialization of assets. So from a hard asset strategy, which was really the dominant strategy forever, to the last 5 years, where with the advent of UPI, digital payment systems, uh, real-time transactions, the number of demat accounts which have got opened thanks to very, very beautiful startups, the
Mm.
whole engagement with virtual assets or digital assets for investors as a whole across the country has got deeply percolated. So from owning, feeling, holding, to understanding that there's something available in a digital format, I
Mm.
think that transformation obviously has now become permanent. So clearly, that is causing products like tokenization or fractionalization
Yeah.
to start becoming prevalent in the country, because people think that they understand that it's okay to own something digitally or fractionally and not necessarily be a title holder and a physical
Mm.
holder of that asset today. I
Mm.
think that entire transformation has obviously helped this asset class.
Mm.
And I'm seeing more of that. I think people are going to continue to move away from owning and managing physical real estate to actually looking at it as a investment virtual asset class. And of course, whether it's AI, whether it's some of the crypto related investments in real estate to meta spaces. I think that's really also going to
Mm.
continue to become prevalent over time. Today,
Mm.
of course, we don't have meta spaces in India as much as we've seen in other markets where people have
Mm.
actually traded meta spaces, and it became a tradable asset class. Fortunately, we're not dabbling into that sort of casino,
Mm.
but I do believe that people have the propensity today, A, with growing per capita income and larger saving potential, their ability to actually take risk and discover new products, invest into new age solutions and investment asset classes will continue to grow. And the Gen X, and now and the Gen X is transforming, and more now the Gen Z and the Gen Next. I
Mm.
think they're becoming more aware, more pro, going digital,
Mm.
take consuming digital investments, being part of this whole digital journey. So I do see that that whole acceleration in favor of REITs, in favor of AIFs, in favor of token products or tokenized products, without a doubt. I think this whole holding to physical assets is something which will become more passe,
Mm.
and it will be more collective investment, so that like in mutual funds, and which is how mutual funds grew. I mean, earlier people used to hold their own physical stocks, then eventually everybody went to mutual funds. So I do see this collective behavior,
Mm.
which is more risk averse, which is more collectively involved and actually balancing out opportunities and risks, becoming more prevalent over time, and which is why the opportunity is so great in favor of managers like ourselves, who are able to actually curate these opportunities, put it together, manage it, and collectively provide that opportunity to a wider audience, as opposed to one person taking that entire risk and managing by themselves.
Yeah.
So I think that, and people again have enough new things happening in their lives to be able to dedicate full time, their
Mm.
time and their effort and their energies and lives towards actually managing, owning, and maintaining assets. Our grandfathers did that.
Mm.
Maybe our fathers did that. I don't think we want to do it. We don't want to be able to every weekend going and looking whether the tenants are okay,
Mm.
going and collecting rents, worrying about whether faucets are broken in that tenanted apartment, or whether
Mm.
the tenant is complaining about why the rent should not be paid. I think people want to get away from all of that. They want it
Mm.
to be simpler. They want to be able to do more with their time and lives. So I think that's clearly happening. In terms of, but what's also interesting is that the regulation needs to play catch up,
True.
because the
Yeah.
transformation and digitization is so fast that unless it is well regulated, it leaves a very large risk of failure and governance in the hands of investors.
Mm.
We've seen that with crypto. We've seen that with a lot of new age assets. Now, today, the whole idea of tokenization and fractionalization is under SEBI's scanner, where they're saying, can it become a MSME REIT, so that anybody who's investing is actually governed, protected, and there is a certain common framework available to anybody who's dabbling in this space. So it's
Yeah.
not anybody's fancy or marketing skill alone. It is very fundamental and is measured by the same yardstick. So I think that's very important. And I'm a very big believer of regulations. I think it's important that while technology is a disruptor, and digitization can create faster, more efficient solutions, but
Mm.
it's even more important to understand that regulations are equally important, because, especially in our country where people can run amok, where ideas can be greater than the fundamentals, I
Mm.
think it's important that the regulator steps in and keeps those
True.
fundamentals intact for the benefit of consumers and
True.
investors. So I've never ventured into fractionalization or tokenization for the simple idea that it's not regulated. And if
Yeah.
it's not regulated, I cannot offer you a yardstick which does not make sense to everybody. So and now that it's likely to get regulated, it becomes an interesting avenue for all of us.
So I'm curious to know, and I completely agree with you. Regulation is very important, especially when we are seeing in the global market what's happening with the politics, what's happening with the economy. Be the example of China, the Evergrande, how it
Mhm.
went along with how it impacted not just the real estate market but the economy of the country. What do you say when it comes to such events happening around in India? How is it going to affect our investment, especially when it comes to the AIF funds? Do you guys consider these setbacks which is happening globally, or do you think it's not going to affect Indian market and we should continue how it's going with the AI fund?
I think it would be foolish to say that we are completely insulated from global shocks.
Mm.
Um, while we are a consumption economy, we're very highly dependent on domestic consumer behavior to propel our GDP. Even if we did no great exports, because of consumption alone, our GDP would grow at 4% plus annually. And I think that's a very, very large driver in favor of our economy. But it's important to understand the lessons that one learns from global shocks and events like these. So, first, too much leverage is a problem. And we've
Yeah.
seen that as one of the largest causes of failure for even not just global companies, but very large Indian companies also.
Yeah.
They were unable to withstand the effect of over leverage when markets went down. So I think it's very important to keep the discipline as to what is optimal leverage levels and what is it that the borrower is able to do to ensure that the leverage is able to be serviced and in a very comfortable way, even in extreme downturns at all times. So I think that discipline is very important. And I think people have realized that. But unfortunately, the memory of the markets remains very small. So I remember in 2008, because of the GFC, everybody talked about deleveragation and let's delever our balance sheets. When 2011-12 money became cheap, we said relever balance sheets.
Mm.
Again, after the Black Swan event, everything again delever balance sheets and let's look at
Mm.
equity. So I think these cycles keep on having, but the fundamental that it must be an acceptable and a
Mm.
manageable level of debt is very important. Second is also understanding whether the construction or development is speculative or is actually catering to a fundamental demand. Like in a lot of ways, I think luxury housing is now being built on speculative demand
Yeah.
because people have seen success in a few quarters and some of the bad decisions of creating very large houses were forgiven because people actually ended up consuming them or buying them.
Mm.
Made people or makes people believe that there's more that can be done. But remember, that was a very small inventory,
Yeah.
which got taken up.
Yeah.
If you're doing 5 times or 10 times as much, the chances that you're going to get stuck again is very high because the consumer base, while it's growing, is not large enough,
Mm.
right? So I think it has to be very fundamental and very rooted in what actually consumers want, as opposed to your own dream of what people should buy or can buy,
Mm.
because there's no data points to that. So I think that's one of the important aspects, and that is why we've seen the problems in larger economies, where to keep up to a certain momentum, especially for listed companies, I think that becomes a challenge.
Mm.
That when you're very large and you need to keep up to a certain momentum or expectations of both equity holders as well as debt holders, you need to continue to build. And
Mm.
when you continue to build, you're then starting to build speculatively. And we've seen a lot of ghost towns and ghost cities in
Yeah.
China. We've
Yeah.
seen stories about how horrific stories about completely empty cities which have left standing, which are now being demolished.
Mm.
So that is the problem or the bane of large listed companies which have got too much capital and too much leverage that they need to show performance. Fortunately, we're not at that level yet, but I would caution people who are growing fast to be aware of these issues. And it's okay
Mm.
to say, I don't think there's an opportunity. The results are going to be flat. The sales are going to be flat.
Mm.
Maybe shareholders will not like it for 1 or 2 quarters, but they'll appreciate the fact that you preserve value. So the need for quarter on quarter earnings growth in real estate, I think, is untenable, unsustainable. There must be rationality. It's not a FMCG company where
Yeah.
it can come up with new products and new markets and penetrate.
Mm.
There's a limitation to real estate. It's
Mm.
still a job shop. And I think once we understand that and listed companies understand that, I think we won't have those issues in India like we've seen in other economies.
So technology has been important and it's been integral in all the industries, especially in even finance and real estate industry. Digital transformation is happening. What kind of tools or what kind of technology are you guys implementing in Nisus Finance to make sure the operations are seamless? To make sure, as you quoted earlier, you go through the data analytics and market intelligence to do the filtration of the projects. What other tools do you guys implement?
So it's important now today for our LPs, our investors, as well as our investee companies to know what's happening on a real time basis,
Yeah.
which basically means that there are enough tools available for real time monitoring, both on site and off site. Were plugged into cloud computing, which means all data goes to the cloud, and we are able to actually pick up data immediately on real time basis, whether it's CRM, whether it's tally data, whether it's actual progress on sites, actual data sheets from sites on a daily basis. This is all today all based on cloud computing and cloud analytics. Second is that today we have got web-based solutions and accessibility available to LP so that they can access the same data in a far more sophisticated and curated way at the click of a button. Earlier, investors had to wait for NAV statements and annual reports from funds to understand what's going on and understand whether they're actually in the money or not in the money. Today they can do that on a real time basis, on a daily, weekly, quarterly, as and when they want to access that data. They can understand their NAV. So there's auto computation, there's auto valuations, there's auto reporting, there's auto data sheets getting created. So a lot of the data is actually getting pulled real time and is getting computed and getting delivered to our investors. That allows us to also be sharp about what is it that is going wrong on a regular basis. So I think from a manager's standpoint, because it's not a listed asset class, so you really don't have daily trade data. What is relevant is the variables and the fundamentals of the operating numbers of the investment. When you're able to collate that, when you're able to analyze that every day, when you're able to put that into a discernible format, and you're able to actually then create variances as to whether it's on track or out of track, actually that gives a lot of intelligence to the investor as to whether they're in the money or likely to be not on the money. So I think that's really where it's happening. Again, one is getting live 24/7 data feeds from the sites. Everybody's into surveillance and monitoring. There's a lot of systems now in place to ensure that there's no pilferage at the site. So a lot of these technological interventions have really helped control the asset as well as report things on a regular basis, which is what we're able to pass on to our LPs.
So the projects where you put the working capital, now there are a lot of corporate companies where the BIM, Building Information Management, when the slab is being put, what kind of concrete is going in, and everything, all those information is also put in the real time so that the developer, even the consumer, can understand what is the progress of the project. Are these kind of tools you guys also looking into?
No, absolutely. See, again, BIM is relevant for a very large project. So if it's a large project, we certainly insist that BIM systems must be in place. Otherwise, the PMCs that we appoint actually have a fairly robust charting system by which they're able to monitor each of the variables. Because remember that these are already projects which have seen a significant life cycle, and therefore most of these variables are fixed. So we know exactly how much materials need to go to complete and what quantity and at what period of time. So these are already variables which have been prefixed and determined. So when a PMC is appointed on site, that's exactly what they're monitoring is the variances and the consumption. It could be on a BIM system if it's a large project, or it could be a simple charting system, which most PMC companies have. But that's clearly a very important aspect is for us to actually receive real-time data on the site.
So how do you predict the technology will be in future in real estate when it comes to finance and investment in real estate?
So I think technology is applicable across different spheres of real estate. I think first starting from the surveying itself, a lot of the surveying was done manually and physically by each one of us. Today there's a lot of drone-led surveying that is possible to understand the micro market around the vicinity of the projects, to understand how the landscape and the topography looks around the particular investment. So there's a lot of drone level surveying that happening, which helps us get better understanding and intelligence about comparables, about the impact areas that we're dealing with. The next thing then really goes into how we can digitally due diligence and do real-time data rooms for us to extract data and information. Fortunately, a lot of the title information is gone digital. When you're looking at land titles, a lot of the information is already digitized. That helps us create very quick virtual data rooms where all the agencies can actually feed off the same data. Earlier, there used to be a lot of time spent in actually collecting the same set of documents by multiple agencies. Today, that time has got compressed, and everybody's getting the same authentic data as everybody else has got. So, can be no discrepancy in terms of what is being offered to multiple parties. So that creates more authenticity in terms of due diligence and documentation. When it comes to monitoring, as I said, there is obviously now technology in place where we're able to monitor it real time, whether it's through BIM, whether it's through CRM systems, whether it's through accounting, so what Tally systems, whether it's actually the feed cams available on site, which actually show images on a real time basis as to what's happening on site, and there's surveillance which is going on a real time basis. So there's a lot of that. And then finally it comes to cloud computing and analytics, which obviously determine how we're able to report. Now, in terms of time and cost, it compresses all of that. B is, of course, there's always an endeavor to see how do we be more ESG compliant, be more environmentally sensitive, and how can technology help that so that there's less pollution, there's less energy consumption, and we're looking at more greener buildings. That's very important for us, as that what we're producing is actually, or supporting is actually ESG compliant. And second, how can technological intervention available in any part of the world be used to reduce the carbon footprint, compress the cost and the time, that is taken to complete the building. So whenever we get in, we certainly analyze, are you doing a conventional method? Are you doing a shutter form method? Are you doing tunnel form method? What method of construction are you using? How you want to compress the time? How you going to ensure that the time available to actually pollute and construct is reduced significantly and bringing down the emissions and pollution levels in the project. So I think that's very important, and that's really where technology plays a very significant part, which is where we mandate the PMC to say, okay, now let's get this done. So our technical teams, the borrower's technical teams, and the PMC, they spend a lot of time pre-investment to actually set out the targets as to how things will progress. So if we need to change the technology, we'll ask them to change the technology so that they can do faster, more efficiently, and at lesser cost and time. It's interesting you mentioned about sustainability in this. So sustainability and eco-friendly practices are being very implemented in current real estate. It's not become the modern lingo or just a lingo to go by. So in Nisus Finance, are you guys also considering those kind of projects which are actually looking into sustainability, eco-friendly practices also? So we've been doing this for quite some time, even before it became the buzzword or the word to talk about, with the COP28 or the G20 or whatever other sustainable norms that our country is putting out for itself and for its peers. We've always looked at ESG as one of the key deliverables for ourselves over the last 7, 8 years. We realized that the more efficient, more sustainable, the more green, the more ESG compliant we are, the better outcomes we've seen in our investment company. We've seen better traction with local communities. We've seen better engagement with the consumer. We've seen better appreciation for the asset that is getting created, even if it means that there must be a certain margin erosion for the producer. And sometimes it does come with a little bit of a regressive thought process that do I really need to spend a little more to get a little more? Or should I go with conventional assets? And I think our intervention, therefore, has always been, Kritika, more than capital. If I have to say that we're a bank, would be wrong because, or a pure financial institution would be wrong because our engagement is actually as an investor, as a partner, wherein we have to understand what is it that we are backing, where are we putting our name to it, is it going to create a product or an asset or an icon that will be remembered for something that it did differently? Just like we create different products and solutions, we want our investee companies to also behave in that fashion. Create something different, be more sustainable, be more responsible, be more accountable. What sort of social impact programs are you going to run for people who are working in and around the projects? What are you going to do to ensure that there is transparency and safety for all people involved? What welfare programs are we going to run? So I think these are very important soft tools that are employed pre-investment, and we ensure that we try and run them to the best possible way and they're ESG compliant. So including, for example, if you're doing bricks, are we doing hollow bricks? Can we ensure that we have enough supply of hollow bricks or fly ash bricks so that we're not using enough and more concrete on site? Can we ensure that there's less transportation involved and do more RMC batching plants on site which are more efficient and green? So I think there's a lot of endeavor that we actually get in to ensure that, and I'm very, very passionate about it. So if the project does not meet the check boxes, so maybe the corporation doesn't need you to have a double piping system where you can recycle wastewater. But if you don't have that, I'm not interested in your project, even if it's going to make money, because it's not sustainable. You need to be able to use wastewater. You're not going to be able to just put it in the sewage. I need you to have an STP. I need you to have a water treatment plant. I need you to find out solutions that you can have solar paneling so that you can reduce energy consumption. These are very critical items for us. See, because again, our objectives are not to put out billions of dollars to work again, Kritika. It's about creating meaningful impact for everybody, for ourselves, for the investors, for the project, for the consumers, and for the society as a whole. And if you're not able to do that, then we're not creating an equitable solution with our capital. It's quite interesting to know, because if it would be a bank or developer, they will say putting these kind of efforts or initiatives is expensive in the books, right? It's not like profit making. And it's good to know that Nisus Finance has been doing this for a pretty long time. Yes, we're very proud of that, and we're happy that, especially in today's age, with the newer generation taking up reins of development companies, I think they are eco-sensitive and their social consciousness is far greater. They're not just driven by profits; they're driven by contribution. They're driven by their impact as individuals and as a company. They're looking at making a statement about who they are and what they do in the society. And ESG is becoming a big part. So I think today there's a far greater maturity, far greater understanding, and far greater recognition of larger companies' responsibilities and their impact on their environment than it ever was before. Because fortunately, in today's market, people are not so much worried about profits or turnover. They're worried about sustainability. they're worried about image, they're worried about recall, they're worried about brand valuation.
Yeah.
And to build all of that, I think it's very critical that each one of them does exactly that, and which is why they're accepting it. And when we have seen REITs, and I think that was a very great turning point when grade A assets were rated out and global investors participated. And that message went out in a very large way to the development community that if you're building a great asset, which is sustainable, which is green, which fits the criteria of global occupiers, you will get global capital and you'll be able to sell at even 6 cap or 7 cap, whereas local developers without all those compliances, you're struggling to sell at 9 cap, 10 cap. So
Yeah.
the value creation and enhancement by doing this can be far greater than using short-term measures. So I think that was a big turning point. I think where people started aspiring to build more efficient, greener, and more sustainable developments, which were acceptable to global capital and audiences.
True. There is a recent proposal by the SEBI that suggests amendments to the rules governing AIF, including the restrictions on borrowing and leveraging by Category 1 and Category 2 of AIF, as well as the requirement for AIF to hold the instrument in a dematerialized form. So, how do you anticipate these proposed changes impacting the operations and investment strategies of Nisus? And please make our viewers and me understand what exactly these regulations are about.
Certainly. So AIF came into being in 2012, and we've been an AIF manager since that period of time. So it's always been now 11 odd years since AIF has been propagated. It started with a very simple idea that a qualified manager, which has the necessary experience, can actually form a pooling vehicle, which could be a trust or a private limited company or an LLP, have enough people who want to invest in a particular strategy, and it can manage that corpus as per the rules of the AIF. Now, category 1, 2, and 3 were decided based strategy. So, somebody who was a sovereign fund, was a federal fund, was an MSME fund, and had direct tax pass through benefits, and was largely related with public sectors, were required to be in Cat 1. People who are dealing with any other strategy, including debt, equity, or alternatives, whether it's art or real estate or any other form, were required to be in category 2. They were considered the more risky asset class. Category 3 was largely limited to people dabbling in public securities. So when you're doing listed stocks, when you're doing hedge funds, when you're doing long short strategy, we're doing commodities, where they are largely listed and tradable securities, that was put in category 3. Now, category 1, because it was largely led by PSUs, had a certain dispensation in terms of what they could do and what they can't do and what powers they have. And it allowed a lot of people to actually put money into that without major concerns. In category 2, leverage was not allowed really, and therefore leverage was allowed in category 1 because it was largely to deal with government led institutions or MSMEs or PSUs. Category 2, because it was to deal with largely risky assets which were not liquid, which were not tradable, the leverage norms were anyway restricted. You could only borrow very short term to meet the working capital requirements of the fund for a very short period of time, let's say about a month. And that also for a very small percentage of your corpus, which is a drawn down capital, because you needed to pay for a certain fee, let's say to the auditor or to the valuer or to the trustee. And there was a mismatch in timing between you receiving that fee and you paying the fee. So, very short amount of leverage was allowed. In category 3, leverage was certainly allowed because again it was traded security. So, like you could do loan against shares, you could do loan against funds, you could do loan against any tradable securities. You could allow a larger amount of leverage. So, therefore, category 3 had the maximum amount of leverage allowed. Now, given the fact that there has been a recognition that AIFs have burgeoned in size since 2012, it started with a very small corpus and has grown at 120% year on year. Today, we are looking at a 7 lakh crore corpus within AIFs compared to mutual fund industry, which is at 37 lakh crores in a 30-year time frame. In a 10-year time frame, we've come at 7 lakh crores. In the next 10 years, it's likely to actually reach 37 lakh crores. So, because of the extraordinary growth and participation of a very wider audience of investors, both domestically and internationally within the AIF regime, I think it is now dawned upon SEBI that it needs to be far more regulated, far more stringent, and far more secured the way a mutual fund industry has been functioning over time.
Yeah.
And therefore, it's no longer just private money and private manager. It's actually now a very large and wider audience of investors, including mid-income investors who are able to commit up to a crore of rupees over a period of time to invest in these strategies. That's really why these measures have been taken. Now, when you take leverage and when you have downturn, the problem of leverage obviously is widely known that leverage can destroy equity.
Yeah.
And obviously, that's not the intention. The intention is this private money must go into investments and should not get destroyed because of leverage or greed of the manager to generate supernormal returns on the back of cheap credit.
Hmm.
So that's something which has now been clearly dissuaded. And of course, there's been very little leverage available practically for AI funds any which ways because of the fact that it's not tradable assets and it's very hard to monetize these securities in favor of any lender. So, notwithstanding that, I think SEBI has rightfully said that the leverage must be limited, it must be very small, and it must be constrained in the hands of AIF managers. I think that's a very important step. We've never taken leverage, by the way. We always believe this is equity capital. Debt should never be taken. We're lenders, we're not borrowers. So if you're not borrowers, then we must put our own capital to work and we must make the best return that is possible in a given situation or a given opportunity. By adding leverage to show supernormal returns is adding risk, which is unnecessary in our case, which is the problem we've seen with NBFCs. Then we start looking like NBFC,
Yeah.
where 100 rupees of capital is leveraged 5 times. And therefore, now the problem is actually to service that 400 rupees of capital as opposed to protecting that 100 rupees of equity. I think that's very important that as AIFs we don't become that. Second, when it comes to dematerialization, I think that's a very important step and something we've been asking for a very long time. So far, there were no rules in the hands of NSDL, CDSL, and demat agencies as to how to demat units. Today, the regulations have been laid down, and it is now possible and imperative that units be dematerialized. Otherwise, how do you know what you actually hold? What is the NAV? You're waiting for a statement. Okay, I'm sending a statement through my RMT agent that this is the money you've invested, these are the units you hold. But where are these units? Where are those certificates? It's finally just a statement. If I lose the letter, where am I going to look for? So it's very important that any investment, any security be held in a demat format, which can be accessible by you, by your successors, your years, your assigns at any point in time, without actually worrying about documentation. So that's a very important step. I'm very happy that that demat is now made mandatory, and everybody will see units in demat format and will therefore know, because that's a natural step to governance. It's a natural step to reporting. Once I start dematerializing, I'll have to start reporting NAV. I'll have to start impairing it. I'll have to start paying tax on NAV. I'll have to start. So the entire alignment of regulations happens once it becomes dematerialized. So long as it's physical, nobody knows. What do I hold? What is the value? What is the taxability? What is the profit? And who is it available to? So all of these questions get very adequately answered on dematerialization. I think it's a very important step. I think the next step would be listing. So far, it's now only about holding something which is untradable in demat.
Yeah.
Because it's private. But what if I want to sell it? I want to leverage it. I want to trade it. I want to transfer it. How do I do that? There must be an exchange for it. So the rules for listing were laid long back, but exchange they were not codified in any of the exchanges. So while SEBI may propagate or promulgate that it's possible to list demat units, and I think that's the first step, and it's very important that now that dematerialization is happening, it will now probably lead to the possibility of listing these units on exchanges, like we have REIT units. So now, why shouldn't an AIF unit? Because a REIT is nothing but an AIF. It's an alternate investment fund, except that it has now got a slightly separate regulations as to how that fund needs to be managed and who can invest.
Yeah.
But still an alternate asset class. It's not a mainstream asset. So like you can list REITs, you should be able to list AIF funds as well. So that anybody who wants to exit can exit. Why is he locked in for 5 years or 6 years? I had the money I invested. Now today I need that liquidity. But somebody else has the money to buy. I should be able to transfer it on the exchange at fair price and not be subject to the whims of the investment manager or locked in with the investment manager. So I think that's a very important step. And as the next logical step is now listing of these. So DMAT first, aligning the whole regulations along with DMAT, and then moving to the listing regime.
So there are a lot of entry of now AI funds companies. Could you make me understand, is there any entry barrier if you're like, if I'm a individual who have a lot of stakeholders fund, can I also start with an AI fund?
You're absolutely right, and that's one of the pitfalls I mention every time is that the entry barriers today are still very low. The
Okay.
capital contribution required is capped at 5 crore rupees. Okay, so 2.5% capped at 5 crore rupees. That's a very small amount today for anybody to put together and start an AI fund, right? So I think it's very important that the track record of the manager, of course, they ask for credentials, they ask for track record. SEBI, by the way, takes a lot of due diligence and is fairly stringent about who they accord an AIF license to. But still, I think the entry barriers are low because of the capital employed by the manager.
Yeah.
Once the capital employed by the manager, the sponsor is higher, then the entry barriers to set up a mutual fund is very high because of distribution costs, because of the AUM, because of so many other issues. Everybody cannot set up a mutual fund. Everybody cannot set up an insurance company.
Yeah.
But anybody can set up a 20 crore AIF because that's the minimum threshold required to raise. So long as you can raise 20 crores, you can be an AIF manager, where your
Mm.
skin in the game is 2.5%. It's very small. Fortunately, today, I think what's happening is that SEBI's also recognized this fact and they're putting in a lot more measures. So they're asking for where is that money coming from? Is it your own capital? Is it third party capital? Plus, what has been your track record and ensuring that whatever is promised actually happening. So there is no evergreening, there's no stuffing of assets.
Mm.
You're not taking third party assets and stuffing it to third party investors and making money on the spread on the side. It's ensuring that you don't keep on, rolling over AIFs from one fund to the other.
Mm.
The terms are finite. You cannot keep on extending terms. So a lot of the governance measures that now today SEBI is saying is something that we have always promulgated, followed, and always hoped that these would become stops or checks or measures that the regulator would have for everybody. So while it was codified, it was never implemented or discerned upon. Now today, given that people have AIs running for 12, 13 years, I mean almost as long as the regulations have been around and haven't actually closed that fund, haven't actually returned back the money, while it was supposed to be a 4 year or 5 year fund, it's now running for 10, 11 years. I think that's really what's, sort of kept these regulations sharp, saying now we have enough evidence, we have enough history of 10 years to now see what went right, what went wrong, what needs to happen, so that this now becomes a mainstream investment asset class,
Yeah.
not just an alternate asset class.
Yeah.
Given the size, given that it's likely to reach mutual fund size in India, it must have all the checks and balances like a mutual fund should, and that's really where the endeavors are.
So a thorough check always happen if even you have opened a AI fund, where the money is coming from,
Absolutely,
who are the investors,
absolutely,
where are they are based out of. All those thorough checks
absolutely,
happen.
absolutely.
Okay. So I want to know from you, recently this Central Board of Direct Taxes clarification has come regarding the taxation of non-resident investors' income from offshore investment through an AIF fund in an international financial service center that is in India is Gujarat, Gift City. So does this clarification present any new opportunities or challenges for Nisus Finance for its operations? And what is also your take when it comes to Gift City investment?
I'm super excited about Gift City, Kritika. In fact, I was in Gujarat last week, and I'm there now almost every fortnight or every month. We've set up our office in Gift City. We're now getting a license to be a manager in Gift City as an international investor advisor, and I think it's one of the most daunting, the most expansive, and one of the largest opportunities available in India for
Mm.
investment manager for multiple reasons. The first is that's the only IFSC in the country, the only international financial services center which allows pooling of any capital, global or domestic,
Yeah.
for multiple strategies. B, it's tax free for 10 years. No
Yeah.
income tax, no GST, no taxation, no stamp duty. I can operate out of that region without worrying about taxes, and it's a complete pass through. It's a single stop shop. There's a single regulator within the SEZ and within IFSC who's now tasked with this whole responsibility of maintaining the regulations and governance. And it's very very progressive. It's on the lines of what we've seen in the IFC in Dubai, what we've seen with Singapore, with Mass Monetary Authority, where you can actually do investments like you would do sitting out of Singapore or sitting out of Mauritius or sitting out of DIFC in Dubai,
Mm.
which are the one of some, or even Luxembourg, which are some of the largest and most popular investment jurisdictions in the world. So when you have those regulations, we can actually create a very directed investment
Mm.
and does not necessarily have to follow all of AIF regulations. It actually meets investor requirements, which means as an NRI, I'm coming in, I only want to invest into this opportunity. I can come into Gift City, I can invest in that opportunity, I can take my money back tax free. I think that's fantastic. Purely today, the largest opportunity
Mm.
is for Gift City, and this whole question about NRI taxation was a very big question because the rules for NRI investment when they're investing in India or India opportunities is very clear. They fall in a very different tax slab, both
Mm.
in debt as well as in equity. And the
Mm.
taxation levels are very high, whether it's doing from NRE account or NRO account. And there was always this concern that if I came to Gift City, would I be subject to the same scrutiny, to the same regulations, and to the same taxation? This whole freeing up of tax for the NRI investor means that today the diaspora, which is so keen, wanting to make that investment, there's so much liquidity, there's so much wealth within the Indian diaspora, which is wanting to make that investment, is today actually freed of this burden of wondering, should I come from NRE, come from NRO, who will get taxed, can I buy this, can I buy that, can I invest in an AI fund, no I can't, so can I buy a demat security, no I can't if it's not listed, can I buy unlisted. There's so many constraints for an NRI investor if he's not a tax resident in India, that all of these dissipate when they come to Gift City. He's able to play the entire investment market more freely. Capital can come in freely without any concerns, without any issues, and it can go back freely as well. So I think that's a very large and very important change. We're very excited because we think that what we've done in the last 10 years as AIF managers and the corpus that we managed and built, we can do it in one third the time in Gift City. And that's why we're very excited about where Gift City is and what's happening with it, and the opportunity it has presented to all of us.
So recently we heard this news that Nisus Finance had raised fund from Singapore. Could you tell us about this fundraise? What has happened behind it?
So we've been a domestic fund manager for the last 10 years, Kritika, and AIFs have been an emerging asset class, and foreign investors have directly come through FDI or FPI route. But in today's environment, we have seen that the interest for India as an investment destination has increased exponentially. And not everybody has the ability or the infrastructure to invest directly as an FDI or as an FPI in the country. Which means in any of our travels, and I've been actually selling the India opportunity for the last 20 years as a manager, and it's been hard. People have looked at Asia, but ex-India sometimes. People have looked at India, but very selectively into public equities and to specific opportunities or technology. But investing into alternatives has been a difficult terrain for most global investors because it hadn't matured or emerged enough for them to completely understand. Today, it's an obvious choice. You don't necessarily have to now come to FDI or FPI. You directly come in as an AIF and you can play the India opportunity like a domestic investor without any concern. Now, that's a very powerful situation for us. Now, that requires that we actually create the pooling vehicle in the geographies that are likely to contribute the most capital. So that's why we have the Singapore vehicle. The Singapore vehicle's objective is to actually pool in the interest of investors, could be the Indian diaspora, who are now residents of Singapore and of the greater South Asian economies, largely coming out of Hong Kong, coming out of Korea, South Korea, coming out of Japan, and even some of those folks out of Europe and US who are now domiciled and resident in Singapore, because Singapore was the foremost jurisdiction in Asia for pooling in global capital because it has the most evolved and governed regime within the Monetary Authority of Singapore, which allowed people to actually come to Singapore and have a very complete, transparent, and tax pass-through investment vehicle in Singapore. So all that capital, which is now resident in Singapore, which may have originated in any part of Asia or originated within the US or Europe, is obviously now in Singapore and looking to find its way into India, as opposed to directly coming into India and then having to work with the double tax avoidance treaty with each of these investors and their KYCs. A lot of investors actually prefer, because they have bank accounts and residencies in Singapore, to actually pool money in Singapore dollars or US dollars in Singapore. So that's really how we got started with the first $100 million of commitments, saying, okay, let's $100 million now co-invest or invest in the AIF. That way it can actually find the conduit to this opportunity that we're currently pursuing, which generates a significantly high dollar-based yield for the investor. So remember, while interest rates have risen globally, but still it's in the single digits, 4%, 5%, 6%, which was earlier maybe 1%, 2% or less. But the inflationary environment in global economies is far greater. So when the interest regimes were 1, 2%, the inflation was nearly zero. And so therefore, on a real basis, people were still able to earn positive yields. Today, they don't, because the inflation, for example, in the UK and many parts of Europe is nearly in double digits, which means a single digit dollar return or a euro return is not sufficient. So they will have to come to us. And when they come to us and they see, well, I'm able to generate 15, 16, 17% dollar returns. Now, that's a very attractive proposition in a secure environment, in a highly collateralized and protective environment with the regimes that we have today, regulatory, and the beauty of the currency being fairly stable compared to most of the other global and Asian currencies in terms of volatility. So the rupee has shown one of the least volatilities as compared to the dollar.
Yeah.
And that makes it very attractive because now the hedging costs are lower, your confidence in the rupee is higher, your ability to therefore predict that on a dollar basis, on a fully hedged basis, I can actually generate, high teen returns. Now that is really what drove this whole decision, that people said, well, we like to come in, how do you allow us? I said, then the best way is let's have this vehicle in Singapore. It's a jurisdiction everybody understands. Your capital is already there. Let it create a conduit for our special situations fund. And that's how we got started with Singapore.
Lastly, I want to know, as the founder and the MD of Nisus Finance, what are your future plans for the company? What are the future plans with regards to even expansion of the services?
That's a secret, right? Okay, well, no, I'm very excited to share. What we're trying to do is very simple. Today, the special situations fund that we currently are investing and that we've launched and which is now investing, I think is a very large, expansive idea. Which is why we have the Singapore pooling, we have the Gift City, and we have our domestic AIF, which cumulatively can put almost $500 million to work in the top 1% opportunity in the space. So that's how large the opportunity, that if I just target the top 1%, I can actually put $500 million to work. So that's the first thing that we're trying to go and expand out in a big way. Second is, as I was talking earlier, that the shared environment, we like yields. Today it's a yield environment. Yields are high, interest rates are high, yields are high, and people are looking at stable and continued yields in real estate assets. Now, office space may or may not be able to provide that in a classical format the way I see it. I've done a REIT in the past. But I think the shared economy environment, when you look at co-working, now co-working by itself has shown the largest amount of growth in terms of grade A office space absorption over the last 24 months.
Yeah.
The share has actually shot up to double digits. It was in single digits. And as a strategy, the largest REITs are creating spaces for co-working environments. Now that's a very expansive idea. And the yields are obviously far greater than what you'd have in a classical format because it's a shared environment. So there's more efficiency of space.
Yeah.
There's more efficiency of utilization of a sweating of assets. We're seeing the same thing now in resurgence of co-living assets. When you're looking at student accommodation, we're looking at other shared assets, with people going back to schools, back to work, back to jobs. I think this whole shared economy assets have a very huge potential, especially now that we've learned what is that people want in a black swan event. How do we create that safety norms? How do we create enough bells and whistles to ensure that people have what it takes to live out of a shared and work out of a shared environment? I think that's a very expansive idea, which is at the fledgling or at the cusp of a huge growth. So that's the other product and the other investment opportunity that we're curating, which we're likely to offer. The third is an opportunity where there is enough potential within the top 10 developers to create great products. So what does a top 10 developer need? He needs a land in the right location, at the right price, which he can build and sell. Now, land may be available in the hands of a landowner who's in distress. And the developer is obviously also looking at a shortage of capital. So today, the expansion opportunity or consolidation is obviously limited by capital. So what if we can marry these things? We take a top grade A developer in the city and we take a stressed asset owner and we actually marry them and create that capitalization so that effectively, while the grade A developer is not going to be ever willing or able or required to pay a very high rate of return or profits to me, because of this situation where I'm actually creating this marriage, I'm able to actually create a very secured margin on my investment in the hands of a grade A developer. Because I'm creating this alliance, I have the ability to take this asset, solve the capital issue in this, discharge the loan, and say, okay, now here's this asset, please monetize it and give me these returns. So that creates a win-win. So it's about curating these opportunities in a scenario where there's consolidation happening and creating that acceleration of consolidation by marrying, to the interested parties or related parties. I think that's the idea. That's the third idea, which means that it's a multiples game now. It's no longer a 18, 20, 22% coupon business. It's actually a 35% return business, which means you actually double your money every 2.5 years.
So that's the third thing that we're expanding, because that's the opportunity. So there's a
Mm.
huge set of people who thought they'll become developers, land bank, and now really don't have the ability to move forward.
Yeah.
And here are developers who are wondering which is the next project which I can do, but I'm not going to buy any more land. So
Mm.
of course they're trying to do their own searches, but by the way, these people have already come to us saying, "Can you rescue me from this loan?" But you don't have the capability to build it, so let's create this marriage, and
Mm.
let's then create that spread for ourselves, so that everybody's in a better situation. So that's really as far as the domestic environment goes. As far as offshore goes, and that's the other thing that we're now launching is a global fund, because I think there is an opportunity when we are facing geopolitical shocks and we've seen a softness in asset pricing. um, I think it's a great time. Again, being counter cyclical and intuitive is going to those economies and buying something at a low price, which is yielding
Mm.
and which can actually generate 10, 11, 12% dollar returns. So today, a lot of great assets globally are able to dispose of those assets because the owners are stuck for liquidity,
Yeah.
especially with the geopolitical shocks, with the interest rate rising. They're not able to service those loans because they over leverage those assets. They're able to take a haircut, because when they were a 3% regime and suddenly it goes to an 8% regime, who's going to pay that balance 5%? Somebody has to pay it. Now, that's not something I can pay because I over leveraged,
Mm.
right? I took a remortgage on that asset. So they take a haircut. The banks will take a haircut, the owner will take a haircut and get a cheap asset. So today, we've been to identify absolutely core prime assets in great countries and economies with a 10, 11% net dollar yield. Now, when I can do that, and then obviously that's in the growths where when the cycle comes back and interest rates reverse, I'll end up making 18 to 20% returns without a doubt. So
Mm.
that's the opportunity where, under the Gift City route and the LRS, and if we can have that diversification in a small way, where we can actually, because we understand real estate, we understand the dynamics, can we use that opportunity to now for India to play global? It was
Mm.
always global playing India.
Yeah.
Now can Indians play global? So
Mm.
that's really where our largest endeavor is in this
Mm.
financial year.
So, lastly, now I'll start the rapid fire, which is
Okay.
quite famous in our series. For this rapid fire, you need to not think too much, give
Okay.
immediate answer to the question. Let's begin with the first one. Describe your vision for Nisus Finance in 3 words.
Most admired investment manager.
Okay. One piece of advice for aspiring entrepreneurs looking to enter the real estate investment industry.
Do your homework, be patient. Nothing happens overnight.
True. One word to describe your leadership style in Nisus Finance.
Hands on and coaching based.
Coaching based. Okay. Mentor.
Mentoring.
Okay. What's your favorite real estate project that Nisus Finance has been involved in and why?
I think every one of them is one. It'll be unfair for me to pick one because each of them is a gem.
Okay. As a leader, what's your secret sauce for motivating and inspiring your team?
Lead from the front, take the blame first, give
Hmm.
credit to your team first, do what it takes to get it done, and take the team along with it.
Interesting. In your opinion, what's the most underrated aspect of real estate investment that people often overlook?
The integrity of the project. People
Hmm.
get led by brands,
Yeah.
they don't go by the integrity of the project.
So, how do you balance risk and reward when making investment decisions?
I think risk is more important than reward. So the
Hmm.
focus is clearly on risk,
Yeah.
reward comes later. If you manage risk, rewards will come by default.
Rapidly rising demand or sustainable growth, which factor do you prioritize more when considering investment opportunities?
Without a doubt, sustainable growth.
Okay. If you had to invest in one, which would it be? A cryptocurrency or fractional ownership?
Neither.
Neither? Okay. In your view, what will be the biggest game changer in the real estate industry in the next decade?
The digitization of all the assets from physical to virtual, but in a regulated environment.
Of course. As a company, what are the top three values that drive your decision making process?
Ethics and integrity,
Hmm.
B, disclosure and governance, C, spotting opportunities and moving fast.
And the book which you resonate with and why?
Oh, that's a hard one. I mean, there are a lot of books, but the one which really transformed my life was The Goal,
Hmm.
which actually taught me to think differently and solve problems differently.
The most memorable moment of your career in Nisus Finance?
Wow. When we raised our first fund, it was difficult to raise the first fund as a startup. And the day we raised our first fund, announced the first close, was when we knew that we are here to stay.
Nice. What do you enjoy the most about being the MD of Nisus Finance?
The responsibility and the faith that people have put on me, both as colleagues and as investors.
What's your go-to stress reliever after a long day at office?
My twin daughters.
Okay, if you could switch careers for a day, what profession would you choose to experience?
I would possibly run a food stall.
Food stall, and what kind of food stall?
Any fast food stall on a beach
Okay.
with a nice cold drink.
What's one thing that people might be surprised to learn about you?
I'm an explorer by heart. I generally do not go to in any visits go to the core locations, but in off-beaten locations more often than not. And B, I'm a fun-loving guy. I don't appear that way most of the times.
What's the best piece of real estate investment advice you would give to viewers looking to explore AIF options?
First, it's a fantastic time to be in an AIF today than it ever was, given that the churn has already happened in favor of the brave, the sustained managers, and obviously the opportunity set is very very vibrant. But do your homework, look at their track record, see their misses and hits, and then take a very informed decision.
So thank you so much, Amit, for joining us today and sharing some valuable insights. It
My
was a
pleasure.
pleasure to have you.
My pleasure too.
And I wish you continued success in Nisus Finance, and I wish continued success for Nisus Finance under your leadership.
Thank you so much, Kritika. All the best to you too. It was a real pleasure being here today with you.
Thank you.